Welcome everyone. Thanks for joining us here this morning for at least 3 hours of exciting options education. Thanks for taking time out on your Saturdays. If you could take your seats and make sure your phones are off, we'd appreciate it. My name is Ed Modla. I'm the Director of Retail Education at the Options Industry Council. I'll be presenting with you today along with Marty Kearney, who's representing NASDAQ. A little bit about my background. I started in the industry straight out of college back in 1997. Went from college right to the trading floors in Chicago and spent the first handful of years of my career in the trading pits, both as a clerk and as a full-time market maker options trader. Then I moved to the electronic environment at the turn of the century, like so many others in our business, as the market making side of the industry started to die out and became more difficult to be profitable. Moved to the electronic trading environment and then shifted my career right around 2010 into more service. So I got into brokerage. I was a futures broker for a while, and then got into the educational side of the business. So here I am for the last 4+ years, almost 5 years, giving presentations and educating the public on the listed options products. So happy to be here today, and I'll be one of your speakers, as I said, along with Mr. Marty Kearney. Today's presentations are really going to attempt to stretch your depth of knowledge a bit. We're going to get into multi-leg strategies and offer some intricate details along the way. But really what we want to do is give something for everybody. So while we do that and give you descriptions of the risk profile of different strategies and how they're constructed, and maybe include some discussion about Greeks and what they are and what they mean, we'll also back that up and fill it in with plenty of a basic education. So there should be something here no matter what education level that you're at. Here's our disclaimer. Options are not suitable for everyone. There certainly is a need for understanding the product and having a deep, thorough knowledge base before you start trading options in a live account. There's going to be a lot of examples we go through today and some numbers and computations. We'll try to keep that as simple as possible, but we did not include some certain important costs like commissions, fees, margin, and taxes. Those are important in a live account. We won't include those today. A little bit about OIC. We were founded back in 1992. Our funding comes from the OCC, or the Options Clearing Corporation. We operate off of a budget provided to us by OCC, and everything we offer is free of charge. Our website is optionseducation.org. There's plenty of written educational material there. There's podcasts, videos, and webinars, along with one of our marquee offerings. Every month we do 2 online webinars. Next month, for example, we're having a special event session on October 23rd. I'd encourage you to sign up for that. A series of presentations with some guest speakers, including one of the most well-known educators in the business, Larry McMillan, will be our headlining keynote speaker. That's October 23rd. So go to the website, check out that link for the events tab, and sign up for that. We're really looking forward to that. Also, the service desk. I want to mention the guys at our investor services team who work for OCC. You can reach them by email at options@theocc.com, another free service. These are options professionals that have a background in trading and in brokerage, and they can answer your questions. If you're interested in what we have on our website, they can direct you to the right spot for various topics. Also, if you have an options question and you want to know the risk profile of a strategy, or if there's a concept that you have a question on, these guys will actually help you, so you can send them an email. For the online audience, I want to welcome you as well. I know there's hundreds of you online tuning in, listening to these presentations today. Feel free to send your questions in. The manager of the investor services team, Mark Benzaquin, is behind the scenes online answering your questions live as you type them in. For the in-person audience, feel free to raise your hand if you get stuck on something as we go through. If there's a concept or a term that we described that you don't quite grasp, feel free to raise your hand and ask that question. Otherwise, to make sure we get through everything and we move along rather quickly, if you have any general questions, we'll save those until the end. So take advantage of our services. We hope you enjoy the presentations today. These are the U.S. listed options exchanges. This is where all the action takes place, where you send your orders, they get executed here. They decide what stocks list options, what strike prices are available. They run the business, and that's where all the activity takes place at the exchange level. So as we move forward with today's presentation on debit spreads, I want to bring up Marty Kearney representing NASDAQ. Let's give Marty a nice welcome to the presentation. And take it away, Marty.
Don't applaud yet. Let's see how this goes, right? Well, thank you for coming up, getting out so early in the morning, you people in Dallas and you people at home, wherever you are. We are thrilled to be here. As was said, I am representing the NASDAQ today. Real quickly on my background, I started out as an individual investor many, many years ago. Actually, it was 100 years ago this week, I believe, that I started out. But I was working for a real company. I had a real job. And I started out doing the covered right. And to me, it was so simple. I owned some shares of stock. The stock was about $35, $36 per share. The stock isn't real important. But I sold some 40 strike price calls. So I would have, and we're going to back and fill a little bit with basics. So we hope we're not slowing down you people that are a little bit more advanced. But by selling the 40 strike price call, I had an obligation to deliver shares, didn't I? But I got paid. So my thought was, well, if I've got like 1,800 shares and I sell 5 calls and the stock's at 36, if you want to pay me to take the stock away at 40, you got it. It's yours. You can have the stock. I have more of it in inventory, don't I? Okay? In the first 3 or 4 times I did the covered right, the options expired worthless, and I thought, this is like just a massive dividend, isn't it? Okay? Where I own the stock, I didn't have to do anything. There's no margin required. You put up your stock as collateral with your brokerage firm. Okay? And from there I went and did a few more trades, and one of them I'll explain to you during our first presentation today was the next trade I did. That I didn't have the capital to buy more stock, so that I found a different way to kind of mimic the same thing. Okay? So then I went down to the trading floor. I had friends at the floors in Chicago, all of the different floors, the Mark, the Board of Trade, etc. And I traded on the floor for myself for 10 years. I traded as part of a group for 6 years on the trading floor. The last 4 I started a securities firm. And then I joined the exchange, one of the exchanges listed here, and I was on their staff for about 19 years. So if you can think of a strategy, I've lost money at least once. Okay? But I'm pretty darn familiar with options, and if you have questions, as was said, by all means, absolutely, raise your hand, you people at home, send the questions in. Mark will answer it if it's something specific to you, but we will get your questions before the end of this session. And as many as we can fit in, we will answer so everybody gets to hear them. Okay? So let's go ahead and keep moving along here. Yeah, options volume. You can see where I retired, all of a sudden some of the options kind of tapered off, right? We didn't get the expansion after I left, but I'm back here working for NASDAQ today. And people can use options. And you know, people use options for a variety of reasons. You know, what I was trying to do with that covered call was I was trying to enhance my return, wasn't I? I was trying to bring in some money, okay? You can do it if you are directional and bullish or bearish, okay? You can do it if you're neutral. You can do it to reduce risk. How many people just in the Dallas, you people at home can raise your hand, but I can't see it quite that far. How many people in the Dallas audience right now own puts? Okay, so I'd say maybe about a quarter of you do. Every one of you owns puts. You have health insurance, you have life insurance, you have automobile insurance. These are puts, aren't they? You write a check to your insurance company for your car. You hope you don't wreck your car, okay? But if something happens to your car, all of a sudden, they're going to write you a check, aren't they? Or replace the car or do something for you, okay? So you can reduce risk, you can enhance return, right? You can use options as a stock substitute. There's a lot of things that people use options for. So I don't think, to me, options can be used kind of more speculatively, but I think for the most part, I don't think they're a speculative product, okay? You know, especially with what you can do, you can choose what you would like to invest and how much you'd like to risk. So options are popular, and I think they very well should be. Okay, so here's what we're going to do. We're going to talk about the basics of spreads. So a spread trade is, what we're doing here is kind of a conglomerate title here. It's more than one position. Okay, if I buy a call and sell a call, that's a spread. If I buy a call and sell a put, that's a spread. All right, but we're going to go over the basics of what a spread is. All right, we're going to talk about the bullish call spread. All right, and this was one of the things that I told you I'd tell you about. This was the second trade I did right after the covered right years and years ago. We're going to talk about a bearish put spread, what it is, why someone would like to employ this particular strategy. All right. We're going to talk about strike selection. You know, strike selection and expiration selection are two of the more difficult things, I think. Okay, where do I want this contract to take effect? You know, is this where I would like to control this particular underlying stock or ETF? Where would I have the obligation if I'm selling something to have the stock called away from me? Okay, how long would I like to go? And I'll give you a very simple math thing that you can write down for later, okay, when we get to that particular position here. We're going to talk about position management. What happens if you have a position on and your outlook changes? This happens all the time, doesn't it? You know, you can put a position on going out 2 months, and, you know, all of a sudden 2 weeks from now, you know, I no longer feel that way about this particular stock. Close the position. Okay? I was talking to a nice lady here that said that due to some unforeseen circumstances, something happened, and she had to close out all of her positions, and now she has no positions on, and she's hoping to get back in the game again here shortly. And I said, that's fine. You know, you don't need to have a position on all the time. If you don't get a warm and fuzzy feeling in your heart, don't do the trade. Okay? Traders on the floor do trades all the time. Sometimes they trade out of boredom. Okay? That's not good. Don't trade out of boredom. Okay? Or don't put a trade on because someone told you something. You know, do your research and make sure that what you'd like to do. But once you get into the position, what do you do with it? I think sometimes exiting a position can be more difficult than entering the position. Okay? You know, do I take a profit? Do I take a short loss? Okay? And one of the things, in talking about position management, one of the things that I started out as a trader, now here I am trading my own money, being very, very careful, you know, very small trader. Someone told me, you know, you bought this option at $2, it's now trading at $1.60. Okay? If you didn't have this position on today, close your eyes, if you didn't have it on today, and now we have, the stock has moved a little bit, some time has gone off, would you buy that option today at $1.60? I'll give you free commission. Would you buy it at $1.60? And I said to myself, I'm not sure. I don't think maybe I would. You know, maybe I'd pick a different strike if I still feel the same way, or a different expiration. If you wouldn't buy it today at that price, there's a big yellow flag going up, isn't there? Okay, so maybe this could be a time to really analyze that position and decide if you need to adjust it, you know, manage it, or close it out. Okay? So here's what spread basics are. And we talked a little bit about this when we first talked about spreads, right? It involves more than one position. Okay? And traditionally what we're doing is we're buying or selling one option, and we are buying or selling a different option. Okay? It's usually on the same stock or ETF. Okay? It may have the same or different underlying asset. In other words, I've seen people that put on spreads where it's more arbitrage people, where they're long. I don't know if I'm supposed to be using real stocks. You know, they own Coca-Cola, but they hate Pepsi. Okay, you know, maybe that would be a spread, wouldn't it? But it's not an option spread. It might just be some sort of a trading spread. Okay, but when we're talking about options, what we're looking at is it's the same underlying. Okay, it may have different or the same expiration, and it may have the different or same strike prices. Now, I'll give you examples of each of those. Okay, it just turns out that when we put a spread on, we're putting on more than one position. Okay. So some of the different types of spreads, we won't go through all of these. If you have questions about different types of spreads, be sure to raise your hand in a bit if you're here, or send your question in. Okay, we will be talking about vertical spreads. I'll show you an example on the next slide. We'll talk about time spreads. They're also known as calendar spreads or horizontal spreads. All right, and I'll show you diagonal spreads. Diagonal spreads are something that people get into maybe at the next level. Okay, well, let's take a look at each of those. Okay, so here's what we have. We have, in this particular example, we have some call options. You can see that in the left column there. Different strikes, 80, 82 and a half, 85. You know, you'll see it sometimes. You'll be looking at a particular stock and they won't have certain strike prices. Okay, that's just the way things happen. You know, when they bring out new expiration weeks or months. And let me back up. With the expirations, when I first started, we had 3, 6, and 9-month options. Okay, I'm old enough that when I started, the 3 stocks I traded on the trading floor, they were calls only. There were no puts. Okay? Think about how long ago that was. Okay? But what would happen is when the closest in month would roll off, if it was October, we would have January, we would have April, we would add July, wouldn't we? Okay? So what happened was investors said, why don't we have something, I don't like this quarterly stuff. I have something that's a little bit shorter term. So we went with having monthly options on everything. So if you're looking at a stock right now, let's just pick Microsoft, okay? Do we have September options? What is today's date in September? 28th. Okay, so September is pretty much over here, right? Do we have October options in Microsoft? Do we have November options in Microsoft? Absolutely. The third Friday, we have that no matter what stock it is, no matter on what quarterly cycle those stocks are on. So then people said, okay, now, Marty, we like this monthly business, but you know what? My needs are a little bit shorter term. Okay? I need to have something a little bit closer in time. So the more active stocks and ETFs, we now have weekly options. So we have options in Microsoft going out to next Friday, whatever it is, October 4th, or pick your date, okay? And we will have like the 4th, the 11th, and then we have the normal expiration, won't we? Okay? We also have long-term options, leaps, in about a quarter to a third of the stocks. Because some people have said, I like the idea of using options as a stock substitute, but the problem with options is they expire, don't they? Okay? And I would like to use this particular call option, let's say, as a stock substitute on XYZ. Well, guess what? XYZ happens to have options going out to January of 2021 and maybe 2022. Okay? But the options will still expire, won't they? Okay? So one of the things you have is you have lots of choices of expiration. All right? But let's get back to the topic here. What we're looking at here is vertical calendar spreads or time spreads or diagonal spreads. So in this particular case, I'm going to take a look at doing something kind of more the traditional vertical spread. And I'm bullish on this particular stock. So what I'm going to do is take a look at buying the 85 strike price call for October. It expires in 3 weeks or so. Okay. I have the right to buy 100 shares of XYZ or whatever this is at the 85 level, don't I? I control 100 shares and I'm putting up $393. And as Ed said, we're not going to get into the impact of commissions or transaction costs, and they've been coming down, haven't they? Okay? But you know what? $3.93, $393 is a lot to risk. I'm bullish on the stock, but I've only got 3 weeks until expiration. I don't think this stock's going to be a takeover. I don't think it's going to the moon price-wise. So you know what? I'm thinking this stock could go up and test its 200-day moving average at 90. And people can take a look at whatever technical indicators they want. Okay? So I'm going to sell the 90 strike price call and collect $1.63. Now, I don't own the underlying shares, do I? Okay? But I have the right to buy the stock at 85. I have an obligation, if called upon to do so, to deliver 100 shares at the 90 level. This is called a vertical spread. I'm selling the 90 strike price call. I don't own it, so that it looks like I'm just selling something naked. It is covered by the 85 strike price call. Okay? So what's my margin on this? I don't have to put up big margin. It's whatever the difference is. Okay? And that's my risk. Now, the calendar spread, this takes you back to the old trading days. Okay? This was known as a calendar spread or time spread. All right? Why would I, if the stock is trading near $85, I'll just ask the Dallas audience here. If the stock is trading at, in this case, let's say it's trading at $90 per share, why would I buy the January 97.50 strike price call and sell the November 97.50 strike price call? Where do I think the stock is going? Yeah, it's going up. I think we're going to, wherever level we're at right now, I think it's going to move a little higher and approach 97.50. Okay? Well, why is that good? Because that November call is the little carp swimming upstream with time decay, isn't it? Okay? All right, Marty, don't move, okay? It's the little carp swimming upstream. I want that option to decay worthless, okay? But at that point in time, I will own a 2-month option outright, okay? And the stock has moved up. Some time has passed, but I'm doing better. That as the stock moves up, the time spread expands, okay? So if I'm over here and I'm buying a call spread and the stock starts to move higher, the width of the difference of the two prices will expand and get wider, and I own the January option. I'm short the November, okay? So it was called a time spread or a calendar spread, but it's sometimes called a horizontal spread because on the old trading floors, you know, the Octobers would be on this monitor right here, and the Novembers would be here, and the Decembers would be over here, and all these 97.50 strike price calls would all be kind of horizontally lined up, wouldn't they? Okay. So those are interchangeable terms. Ed and I are trying to keep this as complicated as possible. Okay, so we'll jump back and forth between talking about a time spread and a calendar spread. It's the same thing. Okay? So in this case, I have the right to buy the stock at 97.50 through January. I have an obligation to sell a stock at 97.50 through that regular expiration in November. When you talk about, I'll talk about margins here for just a second. Most investors buy time spreads, okay? Why? Because I have a directional opinion, okay? I think we're going higher. This is one of the bullish spreads you could do as an investor if you thought the stock was going to move up towards 97.50. Well, could I sell a calendar spread? You could, okay? But what you're hoping there is something completely different. Remember I showed you, look like a cheerleader at Texas here, don't I? Okay. We want it to go to 97.50. If it goes to 110 or the stock goes to 50, this will collapse, won't it? So I could make money by selling a time spread, all right? But the problem here is if you sell a January option and you buy the November, technically you are not covered. The margin rules say, when you're putting on a two-way spread like this, the margin rules say, okay, you know, Marty's buying an option, he's selling an option. Okay, that's good. Let's go to step 2. What's his risk on this? Well, if November comes and goes and the option expires, I am naked short the 97.50 call, aren't I? Okay? So the margin for this would be, okay, Marty, pay for the November call and fully margin the January that you sold as a naked short sale. Okay? And that could run into the thousands of dollars, all right? So investors buying this spread, you own the January, you're short the November, you'd have to put up, I'm trying to do the math in my head here, you have to put up about $135, wouldn't you? That's your margin, okay? And you have the right to own this stock for an additional 60 days or so, all right? So this is a calendar spread, it's a time spread, it's a horizontal spread, okay? Same strikes, different months. And most investors, as I said, would buy these. Now, where it gets interesting is when people start tweaking what they'd like to do. You know, I like the vertical spread. I like the idea of the time spread. Okay? But what if I were to do something like this? I'm going to buy the one on the right here in the 2021 column. I'm going to buy the January of 2021. This is usually when we just have October, November, January. It's kind of traditionally known as the regular expiration, the third Friday of the month. Okay, so I own the 85 call till that third week in January. I have sold the 90 call in April of 2020. So what do I have here? Right, the right to buy the stock at 85 for the next 15 months. This would be a leaps option, wouldn't it? Okay. What do I have on the other side? Well, I have an obligation to sell a stock for the next 4 or 5 months, 5 or 6 months, at the 90 level. So I'm paying $13.85. I'm collecting $7.05. So I'm paying out of pocket $6 and something, right? $6.80 or so, if my math is correct. So this would be known as a diagonal spread. Okay, it's the same stock. In this example, they are both call options. All right, I'm buying one, selling one. I'm changing expiration dates and I'm changing strike prices, aren't I? Okay? So what I'm doing with something like this is more along the lines of the vertical spread, but I'm giving myself more time. Okay? When we talk about time decay, this is one thing I wanted to talk about. I was going to talk about it a little later, but let's talk about this now. Okay, options decay, don't they? Death, taxes, time decay of options. Those are the three certainties in life. Okay? With options, if I were to take, this is a good one. You might want to write this down. Okay, I've got a stock trading at $50. You people at home, pick up your pen. Find your pen. I'll give you a second. Okay? All right. So the stock is trading at $50. If I'm taking a look at the 50 strike price call 30 days out, there's no dividend. Forget about interest rates. Okay? There's no earnings coming up on the stock. All right? The 30-day 50 strike price call is trading for $1. Okay? That's just a given. All right? What do you think the 2-month 50 strike price call is trading for? Now remember, we're looking at twice as much time, aren't we? So it's going to be worth more money. How much more money? Anybody in Dallas want to guess what the 2-month option is trading for? $2, a very common answer. What were you going to say? 150. Yeah, 150, as we say in Chicago, that's close enough for government work. Okay, it's trading for about a little less than $1.47. So the 2-month option is trading for $1.47, the 50 strike price call. The 3-month option is trading for about $1.71. The 4-month option is trading for about $1.90. Well, why is this important? Now think about this. I'm bullish on XYZ. I think this stock's going higher. I'm going to buy a call option. I'm looking at buying the 1-month 50 strike price at the money call, pay $1. I'm risking $100, all right? What would I do, though, if I were to change my mind on this and I were to buy the 4-month option for $1.90? And let's just, now I'm risking $190 now, right? What if nothing happened? What if 3 months from now, to use a floor trading term, the stock is sharply unchanged? Okay, it's still trading at $50 per share. And I'm making crazy assumptions here, okay, that volatility hasn't changed and interest rates haven't changed, et cetera, all right? The 4-month option trading for $1.90 should be trading for $1, shouldn't it? Should be. That's right, okay? Was that on the disclaimers? I think it was that Ed talked about. Should be, right? The point here is, look at this. If I bought a 4-month option and held it for 3 months, I would get less time decay than buying the 1-month option. Do you see that? Does that make sense to you? So this is why people will say sometimes, hey, if I buy a 1-month option and I've only got 30 days, you know, a 2-month option is $1.47. It's not twice as much. A 3-month option, $1.70. What if I go out to a leap options, right? If I go out 16 months right now and I buy something going out to January of 2021, there's going to be time decay, okay? But you know what? Not that much. This is an expensive option. Maybe the stock is in the money. Maybe the stock is above 85 somewhere. You know, it's not real important to our talk here. But the idea is that particular option, if we take a look at it a month from now and nothing changes, maybe that option isn't trading for $13.85, maybe it's trading at $13.75, right? Or $13.70. It lost a dime, lost 15 cents. Okay? So people will do diagonal spreads saying, I'd like to buy something closer to at the money or slightly in the money, and I will sell something out of the money, but maybe the out of the money option will be closer in time. Okay? Now, selling an April option, I'm not a fan of, this is my own personal opinion, I don't like selling options for more than 60 days. That's just me. Okay? Because I have an obligation, don't I? And if I sell an option, that noise I want to hear coming out of the NASDAQ and the other exchanges is time decay. All right? I want that option to lose value. All right? So in my case, I might buy this January of 2021. Maybe I'd sell an October or November option. Okay? But I wouldn't go out too much further than that. That's just me. Okay? So the idea here with a diagonal spread is I'm buying something usually further out in time. I'm selling something closer in time, and it's buy a call, sell a call, or buy a put, sell a put. Okay, different strike prices. In this case, I'm buying something closer to at or slightly in the money. I'm selling something out of the money because that's where I think this stock will go. I think this stock will drift up to closer to $90 by the spring, and at that point in time, the 90 call that I have, the 90 call that I have sold will expire. Maybe I buy it back. Okay, but maybe it expires, and now I own the 85 strike price call with an additional 10 or 11 months of life, 10 months. Okay, so this is a diagonal. Yeah, so the vertical spread we saw there, we could have a November call, right? We're buying the 85, selling the 90. This is your leftmost box here. Okay, on the right, we could buy a January 90 strike price put. We could sell the 80 strike price put. We've been talking about calls. Now we're switching it off to puts here a little bit. Okay. On the call side, we have the right to buy the stock at 85, an obligation to let it go at 90. On the put side, right, we're switching this around a little bit. I have the right to sell the stock at 90, but I have an obligation to buy it back then at $80 per share. Okay? And why am I doing that? I'm bringing in some premium. I think the stock, in the put side, I don't think the stock is going below $80 per share. I'll bring in that premium, have less at risk. Okay? So these are all calls or all puts, the same expiration. It's pretty simple here. Different strike prices. Right, when we buy a spread, right, we're buying the more expensive strike and selling the less expensive. So you will hear, buying a vertical spread, you will hear this referred to sometimes as a debit spread. Okay, now Ed and I promised you we'd have no math this morning, this early in the morning, right? But a debit spread just means I'm paying money for this particular trade. Okay? So you'll hear a debit spread, you're just paying money. All right, and we have a bullish call vertical spread or a bearish put vertical spread. Two different strategies, but they're both vertical spreads. So we have to figure out, one of the things you need to do on any trade is say, where's the break even on this thing? Okay, if I put this thing on, if I hang on to it until expiration Friday, and by the way, most investors do not wait until expiration Friday. Okay, maybe Ed will have some stats on that. He's going to, after a short break in a bit, he's going to handle the second session, and maybe he can talk to this. Okay, but most investors, you put a position on, it works for you. You know what? Let that little option out to pasture. Let it retire, and live a happy life until expiration. Okay, and if you bought something, you sold it. If you sold it, you buy it back, and you no longer have an obligation. I did this early this year. I was leaving the country to go visit my son with my wife, and I had a covered call on, and it was a week and a half to go. It was trading pretty cheap. I bought it back. I left town, thinking, well, did I throw away some money by buying these worthless calls? No, I'll be back, in a bit. The stock got taken over. It was an oil company. Okay, so I was lucky, okay, that it didn't happen the previous week, or the stock would have been called away from me at a higher price, but still not the price that it went to. Okay, but I don't mind buying back options, and my broker right now, I think they don't charge me something like a ticket charge if I close an option with, I think I pay less than a nickel or something. Okay, so you know what? I'm happy to buy back a worthless option because I just don't need the, what could happen in the next week? Lots can happen, can't it? Okay, I just don't want the obligation. I sold it for 80 cents, it's trading for a nickel, I'll just buy it back. I'm not going to deal with it, okay? All right, so we need to know where our risk reward is, okay? When we're doing a vertical spread, the most we can lose is whatever we paid for that particular spread. We can't lose anything more than that, okay? The maximum reward is the difference in the strike prices less whatever we paid for it, right? So if we buy a vertical spread and we pay $2, it's a $5 call vertical spread. The most we can lose is $5. If this stock goes to zero tomorrow, right, we only paid $2 for the $5 spread. The most we can lose is $2. Misspoke here, okay? If the stock does very, very well, The downside is, well, we bought this $5 vertical spread for 2. If it goes to 5, the most I can make is the $5 spread less the 2 I paid for it. The most I can make is 3. Still 150% return if you want to look at it that way. Okay? But still, the most you can lose on a vertical spread is whatever you pay for the spread, whatever your net debit is. Yeah, we're going to have to define the risk, only within certain parameters. Now, one of the things you'll find is we'll take a look at the bulk call vertical spread and on the next slide, and I'll show you one of the problems you have to be very much aware of if you're trading vertical spreads, okay, with the risk of exercise or assignment, okay? But we'll talk about that in just a second. But back to the break-even point, or the risk. The risk is whatever I pay for this particular spread. Right, so I'm looking at doing a bulk call vertical spread because I think this stock is headed a little higher, and I think the options I buy will expand at a greater rate than the one I'm selling. So it's typically a vertical spread. I'd say, 80, 85, 90% of the people that put some sort of a bullish call spread on are doing just a straight vertical spread. Okay, 2 calls, same expiration, different strike prices. Okay. The strike of the lower call, the strike price is lower, right, than the strike price of the one that I am selling. So I'm buying the lower strike, selling the higher strike call. Okay. It's going to be a debit. Okay. And the reason people sell calls is the main reason is just to lower the cost of the trade. It also lowers the break-even point. Okay, lowers the risk, lowers the break-even point where the stock has to get to if I hang on to it until expiration Friday. Okay. So here's a scenario. All right. We've got this particular investor. All right. They're moderately bullish on Bubble. You people know Bubble, right? They sell those carbonated drinks. Okay, it's trading at $115 a share. You know what? That's kind of pricey, isn't it? If you were to buy 100 shares, you've got to put out $11,500. One of the things that's happened in the last 10 years or so is you don't hear about stocks ever splitting, do you? Okay, that stock goes to $500 a share. They don't do a 5-for-1 split, and all of a sudden it's a $100 stock. And the people that owned 100 shares at 500 now own 500 shares at 100, don't they? Okay, so more and more, I think, the stocks in the U.S. markets, they're pretty darn pricey, aren't they? Okay, and I'm used to trade. When I was a trader, when I was on the floor, I'd trade. I ended up being a moderately large trader, not size-wise. Okay, but I wasn't trading crazy numbers. Okay, and now all of a sudden I'm taking a look at taking a stock position, and I'm thinking to myself, well, I might be able to risk, money for 40 shares of Bubble. Okay. Why? Because look, 40 shares of $115 stock, that's almost $5,000, isn't it? Okay, or $4,500. So I'm not going to buy 500 shares of Bubble, all right? Is there a way that we can work around that? Well, absolutely, okay? I do something like a call spread. So why don't I buy the 115 strike price call? I have the right to buy the stock at 115, no matter how high it goes, at any time between today and expiration Friday. I can exercise my right. I have that right. I will sell an out-of-the-money, that's what OTM means there, the out-of-the-money 120 strike call, right? But it caps the upside. So I have the right to buy it at 115. I have an obligation to sell it at 120. Okay? I don't own the stock, but I control the stock up to 120. So these are the prices. I'm looking out 45 days. What would this be? This would be like November, wouldn't it? Okay? So I'm going to buy the November. Some of you are watching this on a delayed basis. Okay? Let's stick with 45 days for you people, right? I'll buy the 45-day 115 strike call, pay $2. That's $200. And I'm going to sell the 120 strike price call and collect 70 cents times 100 shares, right? That's $70. So I'm paying $130, right? When we take a look at the risk-reward here, what's the most I can gain? Well, it's the difference in the strike prices, isn't it? Okay, and the difference in the strike prices is 5 points less the 130 that I paid. I'm not adding in commissions. Okay, so I have the potential to make $370. That's a pretty nice return. That's almost 300%. What's the most I can lose? You know, if this stock gets clobbered next week or the week after, you know, all of a sudden this is not working at all. And if I don't close the position out, I can risk $130. So where does this stock have to be for me to break even on expiration Friday at the close of trading? Well, that's pretty simple, okay? I own the 115 call. I'm spending $130 on this trade. The stock would have to be at 116.30 to break even, wouldn't it? Okay, if it's above that level, I'd be making money. If it's below that level, I would not be making money. This is one of the things you have to be careful with on the when you're doing spreads like this. Okay, let's just say, let's go to expiration Friday, and you put this position on one time. Okay, and guess what? Expiration's in an hour. Okay, and the stock is trading at 119 even. Are you happy or are you sad? This isn't a trick question. You have the right to buy the stock at 115. You have an obligation to deliver the stock at 120. Happy. I've never seen these, you people at home, the people in front here are deliriously happy. Okay, huge grins on their faces, okay? Yeah, well, this spread is now worth $4, isn't it? The 115 call is $4 in the money. The 120 call, well, it still has an hour of life left, but there's no bid on this option. It's offered at a nickel or something, right? We're happy as a clam, okay? I don't know where that phrase ever came from, but I'm happy as a clam, okay? I was going to say here's the problem. It's not a problem, though, okay? But it's something you should consider. We have an hour to go. If you do nothing on this spread, and we're trading at 119, you paid 130, it's worth $400. Or you paid what did we pay here? Yeah, we paid 130, it's worth $400. The situation is this. On expiration Friday, okay, Ed's group at the Options Clearing Corporation, they are assuming that, hey, this option is 4 points in the money. It's worth $400, isn't it? We're not going to throw that away. You weren't paying attention, okay? You're out rustling cattle or whatever you do down here in Texas, all right? We will automatically exercise the 115 call for you, okay? So you get back from doing whatever you do in Texas, and you know what? On Monday morning, your broker is going to give you a quick call and say, hey, congratulations. You're the happy owner of Bubble. It's trading at 119. And you're thinking, wait a minute, you know, that's the reason I did this trade was because I don't want to tie up that much money by owning Bubble, right? Okay, so as expiration approaches, you have to be thinking ahead, okay, as to what will this position look like next week, right? The options expire in an hour. If I don't want the stock, maybe you do, okay, and that's fine, okay? But if you don't want the shares, rather than take delivery of the shares, pay your broker commission to take delivery of the shares, then sell the shares on Monday, hopefully they don't go down, okay, and pay your broker commission again. And by the way, you have to margin the stock you owned, even though you only owned it for 1 day. Okay, you're going to tie up margin money, okay? You don't need to add a few extra commissions in tying up margin money. So if you don't want the shares, close the position. Okay, I'm going to sell the 115 call and collect $4. Good. Well, don't forget, you've got another hour to go. You've got that 120 call hanging out there, don't you? Well, I don't want to pay a nickel. You know, I'm cheap. Yeah, but you've got risk, and you've got a naked option position that you might not be approved for by your broker. Okay, so close the thing. Be done with both sides of this thing. It did its job, didn't it? You spent 130. It's going out at 400. You did real well. You made 270. You made $270. You can afford to pay a couple of pennies here. Okay, so just be aware. So if you do spreads like this, what's the worst scenario? Okay, and this isn't bad, but it's not ideal for some people to have to take delivery of the stock. Okay, this is what the bull call spread looks like. Now, whenever you see you people at home, whenever you see straight lines here, we've kind of jumped ahead to expiration Friday. Okay, Because obviously, if I put this spread on right now for $130, I could probably turn around and, with a little luck, I could sell it for $130, couldn't I? Okay, but whenever you see straight lines on some sort of a P&L, we're looking at expiration Friday. So below 115, everything expires worthless. Above 120, everything goes to what we call parity. In essence, like if the stock went to 130, the 115 call is $15 in the money, isn't it? The 120 call that you sold is $10 in the money against you. Okay, so the spread widens to 5 points. Okay, so this is the break-even point. That's where the stock would have to be at expiration Friday for me to break even. So this doesn't hurt to take a look at this, even if you're not going to hold on to it until expiration Friday. It kind of gives you a good visual as to where you think the stock would have to go to accomplish whatever you're trying to accomplish. Okay? Yeah, this is the Department of Redundancy Department, right? If we're above 120, as I said, right, everything goes to parity and the maximum is achieved. 115 to 120, right, you're going to exercise the call. The short expires worthless. Be very careful. That was my point of caution to you. Below 115, everything expires worthless. That's not good. We're going to talk about what happens if it lands right at 115 or right at 120 in a second. Okay? Let's take a look at the bear put spread. Okay? In the bear put spread, what we're looking at here is, right, we think the stock's headed lower. I don't want to short the stock. It hasn't worked out well on a couple of pretend meat stocks lately where people shorted the stock. Okay? But I'm bearish on a particular stock. How do I employ a bearish strategy and have as little risk to me as possible? Okay? I'm going to buy a put, and maybe I will sell another put, okay, to lower my break-even point and lower my risk out of pocket. All right? So I'm looking at this particular stock, DOLR, dollar. They make dollars. Okay? They've missed earnings. I think this is just a dog. I hate this stock. Okay? It's trading at $54 a share. I think this thing's headed lower. Okay? Maybe I should take a look at doing a bearish put spread. So I could sell 100 shares short. As a professional, I've done it before. Okay, you better know what you're doing, and obviously the stock could go to theoretically unlimited, couldn't it? And you might not have approval from your broker to sell stock naked short. Okay, and by the way, if you're never sure, okay, if you say to yourself, well, you know, I've never done a vertical spread before, get in touch with your broker and say, you know, I went to an OIC webinar, I've taken a look at vertical spreads, I've never done spreads before, am I approved for spreads? Okay, and sometimes they just have to check a little box and say, well, you are now. Okay, but don't be surprised if you just run in and try to put on a trade and they go, what are you doing? Okay, do you know what you're doing, right? So check with your broker, and he or she or they will set you straight as to what you're allowed to do, okay? So rather than sell 100 shares short, I'm going to buy a put. Maybe I'll even do a vertical spread, okay, to lower my cost. So let's get to the example, okay? So where do we say that stock was? About $54, right? Okay, here's what I'm going to do. I'm going to buy a 60-day. I'm going to go out to December right now. I'm going to buy a December 52.50 put, pay $1.65. I'm going to sell a 50 strike price put, collect 65 cents. Out of pocket, I am risking $1. Okay? Now, this says I'm going to do it 5 times. We can do this for 1, or we can do it, you know, for 5, whatever's easier, right? What's my maximum gain? Well, we talked about that, right? It's the difference in the strike prices. In this case, it's 52.50 less the 50 strike price put that I sold. Okay? We're using numbers here. The bottom line is, right, it's a $2.50 spread. I paid $1 for it. So I'm risking $100 to make $150. I'm doing this 5 times, so I have the potential to make $750. All right? My maximum risk is $100 times 5 times, right? I put this position on 5 times. I'm risking $500. Where's my break even? Well, pretty simple. I own the 52.50 strike price put. I paid $1 for it. The stock would have to be at 51.50 to break me even. It's currently trading at 54. Now remember, I think this is a $40 stock or $45 stock. It's only got to go down about $2.50 for me to break even. Okay? So this is what the dollars and cents are, and here's what it looks like on the graph, right? Stock's currently at 54. You know, starting at expiration Friday, anything below 52.50, we start to make some of that money back, the $100. 51.50 is our break-even point, and anywhere below $50 is where all of a sudden this kicks in, and we're doing well. Okay, you know, we have made our maximum amount here. We risked 1 to make 1.5. Okay, a 2.5 point strike price is kind of close on a spread, I think. You know, more traditionally, I see people do maybe 5 point spreads. Okay, but 2.5 point spreads are not bad. And many of the strike prices, like the ETFs, the SPY, things of that nature that you see, you will see 1 point strike prices, won't you? Okay, what you will see many times is, just for fun, take a look at the open interest on those particular options. Now, the open interest is computed by the Options Clearing Corp. Ed's group does this. They don't change those numbers during the day as they're buying and selling. If you've bought or sold options before, you mark these as opening or closing, don't you? Okay, I'm buying this to open. I'm selling this to open. This goes into the Options Clearing Corporation so they can kind of keep a good track as to what's going on out here. Okay, but you will find many times that the 90, the 95 strike prices, in this case maybe the 50 strike price or the 55 strike price calls and puts have a little bit higher open interest. It's nothing to be concerned about if you're trading 5 or 10. You know, if you want to trade 50 or 100 or something, that's a different story. You know, you've got to be able to put this position on, and you have to be able to take it off, don't you? Okay, but this is what the put spread looks like on a P&L, right? If we're below 50, we get to our maximum profit point. If we're above, if we're between 50 and 52, the same thing I warned you about before. Okay? If we're down at 51 and it's expiration Friday and you own that 52.50 put, we're doing well. You know, we're up 50 cents on this trade right now, but do we want to be short the stock next week when we walk in on Monday morning? Okay? So this is when we should be considering what do we do, how do we adjust this, probably close out the position. Okay? Yeah, and if it's above 52.50, everything expires. Yeah, so when we talk about strike and expiration selection, we have to talk about the risk-reward, don't we? You know, if we buy in the money, there's a higher likelihood of, I wouldn't say profitability, it's a higher likelihood that this thing will be worth something at expiration, won't there? Okay? Our forecast, right, which strike do we think is the best one for us, and expiry or expiration is very, very important. Okay, and you have lots of different choices. The last I saw, and I haven't heard numbers in the last 2 or 3 years, the last I saw there were, I don't know, 350,000 strike prices. And maybe Ed has a better handle on that when he comes up for the Q&A or for the other thing at the next session here. Okay, but you have a lot of choices. And that's why people all of a sudden start to do these, once you get the vertical down, they start to do these diagonals, don't they? You know, I'm tweaking my long. I'd like to go out an extra week on the option I own, right? Or you know, I'd like to go out 3 weeks on this one and only 1 week on the option I'm selling, okay? Most of the things I sell right now, for me, are probably 3 weeks or less, okay? And I also try to stay away from, you know, the things that I'm looking at are when I'm choosing expiry especially, is my computer is set up that when I'm looking at different expiration months, at different expiration months, it's telling me when does the stock announce earnings, okay? So that I'm not putting on a position because I think, oh, this option looks fairly expensive. Well, the reason is because earnings are coming out that week, okay? You know, would I like to stay away from the earnings announcement? Sometimes yes, sometimes no. Mostly yes, I'd like to stay away from that, okay? So the expiration can be very, very important, okay? Yeah, so when we're looking at the long strike, we're buying it to target the upside or downside. All right, the short strike is to offset the cost and lower our break even. Okay, I don't like to limit my gain, but you know what? I have reasonable expectations. That's a phrase you don't hear a lot these days. Reasonable expectations in a lot of things, especially in trading, okay? Right, short-term versus long-term, we talked about the time decay, right? They have 1 month, 2 month, 3 month, 4 month that I talked to you about 20 minutes ago. okay, it typically accelerates. When we get closer to expiration, you know what? That sound you hear is time decay, right? So, if you own that option, you have a decision to make. Usually there's a time decision there with 2 or 3 weeks to go. Do I still feel the same way? Should this be something I should be selling? Okay. The assignment risk, same idea. You could be assigned at any point in time. And I'll cover this very quickly because I don't want to get into the, I think I'm talking my way into the Q&A session here. But we can always do that in the next session too. We can start out with Q&A from this session, okay? One of the things you'll hear about assignment risk is all stocks and all ETFs in the United States are what we call American-style options. It doesn't mean they're American companies or anything else. All that means is the option can be exercised or assigned at any point in time for any reason. Okay. Now, if you bought a 50 call and you sold a 55 call and the stock runs to $70, okay, you're doing okay, right? That thing went to $5. It should be trading pretty close to $5. Okay, but you know what? When does the stock go? This is something you should write down too. When does the stock go ex-dividend? Meaning it starts trading without the dividend. This particular stock, right, pays a 25-cent dividend. The stock's trading at 60. Okay, and if the stock, it goes ex-dividend Monday morning. Well, what that means is Monday morning the stock won't open at 60. It will open at 59.75 if it opens unchanged. Okay, 59.75 unchanged, ex-dividend. What that means is that the person that owns the stock is whole, right? They had a $60 stock on Friday. It's now $59.75, but there's a 25-cent check in the mail to you at some point, in a couple of 3-4 weeks. Okay? It's important to know when does the stock go ex-dividend if you have sold options or if you are long options, but especially if you sold them. That could be a professional exercising the call option to take the stock and capture the dividend. And you could be assigned, right? You don't have any control over that, all right? So it could happen on puts. It's usually when the put goes deep in the money, okay? One of the problems you will have happen then is all of a sudden you're going to get a call from your broker saying, hey, you were long the 50-55 call spread, and now you own the 50 call and you're short 100 shares of stock. What are you going to do? Well, you know what? You're covered, aren't you? Okay? Because you have the right to buy the stock at 50 and now you are short the stock. You are covered. Technically, you are covered, but you're scaring your broker. Okay? Because your broker thinks, did you really know this was a possibility? Okay? So just be very aware, not only of when, if you're looking at initiating a position, when does the stock announce their earnings? But the second thing is, if you have a position on, when does the stock go ex-dividend, and will that affect the value of the call or put that I'm long or short? Okay, so it's important to know that. Okay. Pin risk. This is the last thing I'm going to talk about, and then we're going to open it up for questions here. Pin risk just means this. You own the 50-55 call spread. I own the 50 call. I'm short the 55 call. And you know what? We've got an hour to go, and that stock is trading at what did I say? 50-55 is trading at 54.95. I'm short the 55 call. What's going to happen to that stock? Will it close below 55? Will it close above 55? The term is called pinning. I wrote an article on this in the journal many years ago about how stocks sometimes gravitate towards the strike price. Sometimes yes, sometimes no. Mostly no, but they could. But what happens if the stock lands right at the strike price or a couple of pennies either way? You don't know if someone will exercise a particular option. So just be aware. Don't make assumptions on expiration Friday. Well, I own this, and I'm short this option. The stock will be called away. Maybe. Maybe not. Okay? So if it's right at the strike price, be very careful. Okay. Yeah, so when we're talking about managing, right, if the stock goes up, the bulk call spread widens. Okay? If it goes down, you know what? We could have a situation where the volatility changes, right? This is a very volatile stock. They come out with earnings, and the stock goes up a little bit, and the spread doesn't widen very much. Why did that happen? You know what? The volatility changed. The news is out, right? So do we roll a position? Maybe we'll talk about that in the third session today, right? We'll roll a position up or down. We'll change the position, okay? We covered a lot. In that last session, I know somebody said this was like, sitting through these is like drinking water from a fire hose, okay? But the idea here is you've got a good group of men and women that Ed talked about that answer these questions all the time at optionseducation.org. And they have no affiliation with any brokerage firm or any exchange or anything else. You know, my name is such and such. You know, what's your first name? What can we do for you? Okay. You know, Marty and Ed confused us about puts last Saturday. Huh? Ma'am, you're the fourth caller that called today. You know, what can we help you with here? They're very, very good. What kind of questions do you have here? And we'll see if we have other questions. And we're going to have to kind of cut this one short because I want just a few seconds over here. Any questions on the audience here? Yes, ma'am. And I'll repeat the questions so everybody at home.
So when you are looking at a P&L graph, if you're getting to expiration Friday and you happen to be in between your strike prices, you better close out.
The question was, if you have a position on, like on a vertical spread, and we're approaching expiration Friday and we are between the strike prices, right? Like we own the 50, we're short the 55 call, and we're trading at 54. She's saying you better close this out. I'm not going to say you better, but I'm saying you absolutely should look at that very, very, very seriously. Yes.
Because
so
you could get
you could get
assigned.
assigned, but you could also end up owning the stock. Do you want to pay for the shares? Do you want the risk of owning shares of stock? So what most people would do is, you know, that Tuesday, Wednesday before expiration, they're going to wind this thing down. They're going to take it off. Just because I don't know, I held it for 5 weeks. I can get out of it 2 days early. Okay.
Okay, so that's the one. If it's in between, then if it's worthless, you do nothing because it's worthless.
Yeah, if it's worthless, you do nothing.
But if you're in the money, what happens there?
Okay, good question. So I own the 50-55 call spread. I'm long the 50, short the 55. The stock is trading at 65 right now. What do? You don't have to do anything. Your broker will automatically exercise your 50 call. You will be assigned by someone else that is automatically exercising their 55 call. And this is where I said, though, be very careful, because if it's trading at 55.5 or 56, you're going to exercise the 50, assuming that the 55 should be exercised by someone, and you would be assigned almost is the key word in this phrase. Almost all the time, that's what happens. Occasionally, it doesn't. So don't make assumptions if you're close. If you're if both are deep in the money, don't worry. If they're both out of the money, don't worry. If they're in between, do something. One last question, and then we're going to break it up, and then we'll cover yours in the next session. Yes, sir.
In one of the slides, you said that it might be beneficiary to do debit spreads on in-the-money options. I'm wondering how the extrinsic value changes, whether the option is in the money or out of the money.
Yeah, the at-the-money option, the question was buying in-the-money options in the intrinsic and extrinsic value. Okay, what he's saying there is at-the-money options have no intrinsic value. Okay, it's just all air or extrinsic value. Deep in-the-money options have real intrinsic value. They have small extrinsic. Out-of-the-money options are worthless, okay, technically, at this point in time, and they trade with they have no intrinsic value and small extrinsic value. Deep in the money options don't have that much time premium in them. At the money options do. So they will decay. It won't be the decay curve. I talked about the $1 option, right? That is the typical decay curve for an at the money option. Deep in the money options and out of the money options are more linear. Okay, it's not the same drop off with deep in the money options. All right, then you know what we're going to do? We're going to take 10, 12 minutes. We're going to have Ed come up here, and then we're going to continue answering questions, and we'll move on from there. Okay? Thanks, everybody.